My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, folks. Today, zooming in from beautiful San Diego, California, we got Ryan Coughlin, who is a full-time real estate entrepreneur, and he's kind of switching from doing smaller deals and getting into bigger deals. And what I find really interesting is he and some partners are jumping into starting their own fund. So they're right in the midst of doing that right now. So I think we're having a great conversation. Ryan, welcome to the call. Great to have you.
Thank you very much, Dave. I appreciate it, and I am a fan of the show.
Oh, I appreciate that. Thanks very much. So Ryan, tell me a little bit about what it is you guys are doing. So what have you been doing for the last 3 or 4 years when it comes to real estate investing, and what are you moving into?
Yep, absolutely. Happy to answer that. Over the last 3 to 4 years, I was still in the last part of my commercial banking career. And that was my career for the last 22 years, was focused on commercial banking, and came up in credit and underwriting. So looking at transactions, was my initial deep dive into not only real estate, but financial analysis in all industries
So
and
I'm thinking
companies.
you're a pretty good underwriter.
That's my strength. That's my strength.
Nice.
Analyzing is a fun pastime for me.
For
Uh,
you.
for me,
For some of the rest of us, we'd rather stick a needle in our eye, but yeah.
that's how teams are formed.
Exactly.
And so the last 3, 4 years, I had been working on building my portfolio. I started investing 10 years ago, and I invested in Wisconsin, not too far from where I grew up.
Yeah.
And then about 3 years ago, I chose a market that had some greater density, and began investing in Indianapolis,
In what kind
and
of properties, Ryan?
multifamily and single family residential houses.
Okay, and you're doing this kind of flying solo, doing your own thing. Is that what I'm understanding?
That's right.
So was
That's
it
right.
smaller multifamilies, or were you getting into syndications and that kind of stuff?
Smaller.
Okay.
And what it meant to me was effectively a pilot campaign,
Mm.
using my own money, my own capital, making mistakes myself, going through that learning curve before introducing the idea of using other people's money. OPM gets a lot of traction, and it's a great way to leverage yourself. But for me, I wanted to be, as close to airtight on my own skill set before advertising and leveraging other people's money.
Well, that makes a lot of sense. And coming from a very conservative banking background, perfectly logical. So what kind of a portfolio were you able to build up under your own steam between Wisconsin and Indianapolis, right?
Yeah, I maxed out at 20 units. So
Nice. Good.
between apartment units, condos, and one duplex and a set of houses.
Okay. Well, that ain't bad for flying under your own financial steam. So you're taking the big bucks you're making in San Diego and going to a much more affordable markets.
That's right. Got to stretch
Yeah.
your dollars, and the cost to diversify is less if you.
Yeah. Now, any challenges with getting property management for smaller properties like that at a distance, or did you get that pretty dialed in?
I got it dialed in. To me,
Nice.
that's crucial, and you can't skip over who's going to be the boots on the ground and who is going to have direct access to your property. If you're going to be an out-of-state investor, you have to have confidence in who's managing the property. They're not lifelong contracts, so if somebody doesn't, fulfill what they're contracted to do, you can move on. But I always have an established relationship going into a market with a property management company,
Very
and
good.
usually comes through a network. Talk to people that you know, talk to other investors, get on the phone, talk to people, let them know what you're doing, and then you get a good feel for who would be a good steward for your property.
Yeah, smart. So Ryan, that was then. Now is now. What are you focused on these days, moving forward from, your own personal portfolio? What you're into something new, you're into something kind of poised to be much bigger. Tell us a little bit about that.
Yeah, absolutely. Thanks for asking that. Exciting times. As I mentioned, I was in banking for the last 22 years, and
Mhm.
that transitioned in July. And so real estate is my full-time gig, and I'm
Congratulations.
excited for that to be my reality, and waking up and having some enthusiasm. And the first project, some
I'm
genuine
here. I'm here. A
enthusiasm.
little burnt out. A little bit of burnout happened there over 20 years in banking.
I can't disrespect banking. It gave me stability and took care of the household for a long time. But
Yeah.
I'd be lying if I said I was passionate every day. I mean, I guess that goes with anything. But
Yeah.
yeah, there's some truth behind the burnout. But this first project, the project that we're working on, is going to take the shape of a fund.
Okay.
It's a closed-end fund, and the focus is on the Indianapolis
Okay.
greater.
So let's break this down, Ryan. And you're gonna, if you don't mind, let's just explain it to me like I'm a 12-year-old. What does a closed-end fund mean? Who is we? You're going from being a one-man show, building up this portfolio, to now working as part of a team, and you guys have decided to start a fund. So, kind of first steps first. Who's the team, and how did you guys all get connected?
The team, as of right now, effectively is a two-person show, and
You and one
it's
other person.
one and myself and one other person who's
Okay.
actually a former bank client who I have a great relationship with, and we
Also a real estate investor himself, or
no,
okay, all
he
right. So,
owns some properties personally,
mhm.
and had some money invested in some real estate. He's in the human capital business, and
Which means what?
uh, recruiting, staffing,
Ah, got
uh,
it. Yeah, you
looking for talent, and having contracts to fulfill human capital
got it. Okay,
for
very good.
different companies.
So it's the two of you. You've decided to join forces and you've started a closed end fund. So maybe define what that means. What is a closed end fund?
Absolutely. So the closed-end fund means once that fund closes the door for investors, so the door is open like it is right now, and you can invest in this fund, and there's a date where it ends, where investors can invest until a certain day, and now the door is closed,
Okay.
and that's
No
the
matter how
closed
much
end.
money is in the fund, is there
Cor-
like a upper limit to how much can be in the fund by the time it closes? Or
Yeah, it's set as a $3 million equity raise.
got it.
It's written language allows it to be oversubscribed. But that's the target is $3 million.
Okay. So $3 million by a certain date. Do you mind sharing with us what the date is?
Absolutely. It's April 30th,
April 30th of
2025.
2025. All
Yeah.
right. And how long did you have as an open window with this fund that you guys created?
It actually just opened. So we just flipped the sign around from coming soon to open for
Okay,
business.
so right now we're doing an interview towards the end of October 2024. So the time frame for this fund is basically 5 months, 6 months. Is that what it is?
Yep, yep. And it's 5 months to raise.
5 months.
It's set up to be able to raise money and deploy capital simultaneously. But then after that, the close date, then the life of the fund will be 10 years.
Okay, very good. So I understand you're a banking guy. You're not necessarily a lawyer guy. So we don't expect any, but maybe simplify it for us. What is the big advantage of opening up this kind of a fund versus others?
Yep, and going back a little bit, the closed end has a close date, and typically more investors don't come into that project. With an open-ended fund, the door remains opened.
Kind of
It's
revolving door, right? People
revolves,
can
and people
come in and
can
out, sort of
come
thing.
in and out, and it's more liquid, if you will. And this is a closed-end fund primarily because it's more simple,
Mm,
and it's a lot easier to manage from a bookkeeping perspective too. And with an open-end fund, you are constantly doing your net asset valuation. Everybody
yeah.
needs to know the value of the fund at any point in time. So getting off the ground, thinking about time and energy, having a closed-end fund makes the most amount of sense.
Okay.
And the other advantage is once you have your set of investors, You're in the project together, and you're building a trust with that group of people,
Yeah.
and you can do a lot of work building your reputation and building out the relationship you have with those limited partners
Hmm.
without them being fleeting. So if you have an open-ended fund, the investor could come in, and then the investor could
Go
redeem
up.
their shares and they're out. This
So
allows me
these
to.
guys, you're all locked in arm to arm in arm for the duration of the life of the fund. Is that correct?
There's a 5-year lockup.
Okay.
So
Got
the
it.
nature of the fund is long term. We're looking
Mhm.
for long-term investors. If somebody wants a 2-year exit, this really it's not the project for them.
Yeah.
And the way it's written is a 5-year lockup period. And after 5 years, in between five and the end of the life of the fund, there's a process. So you can ask for a redemption, and
Mhm.
then the partnership will either buy out the exiting partner, or you do a debt refinance and buy out the other partner, or you can go to the open market and the LP can look to sell their partnership interest to somebody else that would be accepted as an investor.
Perfect. All right. Thank you for explaining that, Ryan. It's a lot clearer. Now, let's zoom out a minute or two here. So, total amount of capital that you can raise in this fund is about $3 million, basically. Correct? That's the target that you guys are shooting for.
That's right.
You've got till April 30th to do that. Is there a minimum investment that your partners need to bring in to participate in the fund?
Yes,
Okay.
as I mentioned, we're just getting this business off the ground, so we wanted to set the minimum at a fairly friendly level. So $25,000 is the minimum investment.
Okay, very good. So my math ain't that great, but that would mean potentially how many investors in this fund?
Well, realistically, because everybody won't come in at 25, we're
Yeah,
looking to have about 50 to 70 investors.
got it. All right, very good. And the criteria of the investors for this kind of a fund, what is it? Is it friends and family? Is it accredited investors? Is it a mixture of both? How does this kind of work?
The answer is a mixture of both.
Mhm.
The vehicle for this one, from a regulatory perspective, it's a Reg D 506B. And what that means is it's open to an unlimited number of accredited investors and up to 35 non-accredited investors. And an accredited investor is somebody that earns individually $200,000 a year, or they have a $1 million net worth when you exclude the equity they have in their primary residence.
Got it.
That income threshold is $300,000 for married couples,
Mhm.
and I believe you have to have that established over a certain number of years. So,
Right,
2 out of the
right.
last 3 years.
High income, high net worth type folks.
Yeah,
Yeah. So you can have as many as you want of those guys and up to 35 non-accredited investors as long as they are people that you have a pre-existing relationship with, right?
that's right. And I pride myself on being a good steward. Capital preservation is still number one.
Well, you come
We're
from
all
that
trying.
banking background, right? So
Yeah,
that's good.
and you have to be careful with somebody else's capital.
Hmm.
Everybody should be careful with their own capital, of course, but your guard is really up when you're managing other people's capital. And so if somebody falls into the non-accredited basket, I am poking holes into their excitement to invest, because there could come a day in 3 years where they say, "Hey, I really, really need that cash back." And in a scenario like that, we would try to work with them, but that's not the nature of the fund, and that's
Yeah.
not matching the investment style because we're going long term.
Yeah. So they got to be able to put their 25, 50 grand, whatever it is, in and not lose sleep over that for at least 5 years, basically.
Exactly. That's
Okay.
right.
So you're wanting to raise $3 million in this fund. Once you've got the capital in there, then what? What are you guys going to do with it?
Yeah. And what's neat about the structure is we can buy properties as we're raising.
Hmm.
And so the fund has an 8% preferred return for investors.
Yeah.
And over the long run, it's a non-cumulative return, meaning if you don't have the free cash flow available, or the distributable cash flow available to pay that 8%, then you distribute as close as you can to 8%, and then you move into the next period, and you're not
It
doing a
doesn't
look
it
back to
doesn't
catch
accumulate.
up.
It doesn't Doesn't
Right.
tag on to the next.
Except for the first period. So
Hmm.
anybody that invests, when they make their contribution, that preferred return begins to accrue. And so if you invest before somebody else, your preferred return is accruing. And
Hmm.
that doesn't harm a later investor. They still get their preferred return once their clock begins. But the
Right.
benefit to an early investor is they're getting an assured preferred return. It's earned that first
So
year.
how are we assuring the return through the fund? What are you buying? What's going into the fund? What's generating the cash flow to create these returns for your investors?
Yep. And interesting time in the real estate cycle, obviously. And so on the front end, we're primarily focused on single family residential homes
Yeah.
that we can buy at a significant discount.
Okay.
And this model is effectively getting your return through a discount. That's the first return is walking into some equity, value add, or you simply bought at a discount. And,
So
and
what's the exit strategy with these houses?
Yep, good question. So there's effectively two sets of asset pools that are being built on the front end. There's houses that are built or houses that are purchased for the sake of being long-term cash flow properties.
Okay.
Also
So you're
bought at a
buying
discount.
you're buying fixer uppers that you're going to fix them up and then you're going to rent them out.
Yep. Yeah,
That's
and,
one.
and some don't necessarily need that much fixing up.
Yeah.
You walked into a good inhabitable property, but you got a situational discount on it.
Got it.
And those present themselves. You just have to get enough deal flow and know what you're getting into. So that's one, you're building the cash flow portfolio and then looking at other flips. So there will be properties where the intention is not to keep as a long-term cash flow property, but it's better designed for a flip. And uh, preferably that flip would be to an owner user, not to another investor that wants it to
Yeah.
be a cash flow property. And
Yeah.
so,
You want to maximize your returns for yourselves and your investors. You don't want to be selling them at a discount. You want to be selling them at full retail.
exactly. So on the front end, a portion of the proceeds from the flip activity is what pays out the preferred return.
Yeah.
The remainder is reinvested into more projects. Now, once that portfolio of single family residential houses that's for long-term cash flow is stabilized, and let's say it's 10 homes, just for
Yeah.
an easy round number. Then I go to the debt market and I'm going to put one commercial mortgage against that pool of collateral
Houses.
of
Yeah.
houses.
Yeah.
At that point, the loan proceeds from that collateral pool deal, along with the net proceeds that we've accumulated from the flip activity, that equity will be rolled into a more efficient property. That's when we buy the 100-unit multifamily
Mm.
property, and it's
Okay.
within one fund. And there's two reasons. One, it's a tough time to just go out and buy a 100-unit apartment complex.
Yeah.
So the deals with the larger properties are not, they're harder to find these days and harder to bank on those returns.
Yeah.
And so to have some flexibility and really get into deals where I can find a discount, the numbers are right, and there's just more opportunities to buy at a discount. The be doing that on the front end allows me to have flexibility to get a good return on my equity on the front end and
Yeah.
then roll that into a more efficient property. And
So let me
second,
see if I understand this, Ryan, and forgive me for sounding dumb, but I am.
no, you're not.
So, so the idea is you want to be using the capital in the fund to buy single family homes, a chunk of long term rental properties that you can buy on sale, and you've got instant equity, plus getting mortgage pay down and just natural value appreciation over time, chugging along there. You're using some of the other funds as well to do flips. So you're generating pops of cash that go back into the fund. And then the goal is, while this is all kind of percolating, is to be keeping your eye on the ball for potential bigger multifamily properties. And then when the right one lands, Oh yeah. And then also you want to, once you built up that portfolio of whatever it is, 10 long-term rental properties, then get like a commercial mortgage on all of those, kind of do a bit of a burr. So pulling out a big chunk of equity when you refinance that, that goes into the fund. And now the fund, hopefully in theory, should have enough capital to take down a larger multifamily property. Have I followed
That's
the,
exactly right.
okay.
Yep, that's
So I'm
exactly
following you
right.
there. So waving the magic wand 5 years down the road, if everything went according to plan, what do you see this fund holding? Like what properties are in the fund at that time, realistically?
Yeah, I think realistically, either to a 75 to 100 unit apartment complex,
Uh-huh.
and then the portfolio of cash
Of,
flow
of
of
single family
single
homes,
family.
say it's
Yeah.
10. And
Yep.
then are you continuing to do flips within the fund as well to create more cash flow as well? Or are you kind of stabilizing it with the long-term buy and hold properties?
As I sit here today,
Yeah. Yeah, I
things
get it.
can always change, but
Yeah.
no, we wouldn't continue to flip. It would be, a lot of active work on the front end to get to a place where it's more a predictable stream of revenue down the line. So, 5 to 7 years from now, the assets that it holds are stable.
Stabilized. Yeah.
Yeah.
And that's really what the fund is at that time.
Yeah.
It's holding. Got it. All right. Cool. Very cool. Well, hey, Ryan, thank you very much for kind of unwrapping that for us and simplifying and explaining to us. Sounds very exciting. I love the, I love where you're progressing with your real estate investing business. Now, if people are watching this and saying, hey, that sounds kind of cool, I'd like to connect with Ryan, either to find out more, just to connect or to whatever, what's the best way for them to reach you?
The best way right now, I would say to go to www.flightrealestate.com, and that's FLYTE, flightrealestate.com. Simple page. It's effectively a sign up page. We're still building out our social media platforms. We're building a presence on LinkedIn and that, but going to flightrealestate.com is the easiest way to get a hold of me.
Fantastic. Well, Ryan, I appreciate your time and wish you all the best with this exciting new endeavor.
Thank you very much, Dave. I really appreciate this opportunity. It's great to finally meet you virtually face to face.
Well, thank you. And I think we're going to title this Having Fun with Your First Fund.
You can never have too much fun.
All right. Thanks a lot, Ryan. And everybody, thank you for tuning in. We'll see you in the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.